Fed. The Fed is due to make its next interest rate decision or announce it at 2 p.m. Eastern Time. Sure enough, our guest expects no change in borrowing costs. But what should investors be looking out for here? We're joined by Brian Mulberry, Client Portfolio Manager at Zacks Investment Management. Thanks very much indeed for joining us, Brian. It's interesting. We keep hearing this expression, Powell is between a rock and a hard place, because inflation is not as low as he'd like, but the economy is threatened by a trade war.
Yeah, absolutely. And it's kind of strange days when you have the expectation of no change at all, but it's such a big mover for the market. Really what it comes down to is certainty versus uncertainty. We are looking for clarity in the future meetings from the Fed. We've been in the camp that we expect one or two rate cuts, but later in the year. And I think that's pretty in line with the rest of market expectations. So what it comes down to is parsing out the language. What are they telling us about how they're seeing and feeling about conditions, as you're saying? Economic conditions actually on the hard data side are pretty okay, but sentiment and survey data that's forward-looking has turned very negative in the recent weeks. We've obviously seen that reflected here in U.S. markets, and so the balance has to be struck. Where are we now, and where are we headed? And the market's looking for certainty in those comments, and obviously we'll get some questions and answers from Chairman Powell later this afternoon as well, and we'll all be watched very closely, parsing every word to find out what the future really looks like. At the moment, again, we expect no change in policy rates today and maybe one or two rate cuts later. We will get a summary of economic projections in this meeting as well. That's important to compare where they see things now versus the last SEP released in December. Any material changes there in things like the dot plot or inflation expectations, that could move markets substantially, just as we're, again, in this period of wanting certainty, but obviously so many moving parts are disrupting markets here domestically.
I wonder, though, will they adopt that usual central bank tactic of on the one hand and on the other hand, of course they are, well, economists love to do that too, and say, well, we just don't know the impact of a trade war yet.
Yeah, I think any strongly worded statement would absolutely be scrutinized by the market one way or the other. There's definitely hawkish language and there's dovish language, and the market is hanging on every word, looking for that influence to see if it actually will answer a question. To your point, Chairman Powell has been very adept at not answering much of anything, and that's really kind of their job, is to be neutral and independent and simply worry about their mandates, which is full employment and stable prices. We have one half of that, I think, pretty squarely in view, which is the labor market's fairly strong. On the long scale of things, 4.1% unemployment is a relatively low number historically, and we are still, on the balance, creating new jobs while not losing a whole lot of jobs at the same time. So that's a relatively stable picture there for the backdrop. The question there now becomes, are we still winning the war against inflation? Are we seeing more disinflation at this period of time? And there's some data out there that suggest prices are stable, but they're not coming down closer to that 2% target, which again is why we expect no change in policy rates. We need to stay in this restrictive rate environment in order to put pressure on prices to come down. The thing for stocks is the longer that rates stay higher, it erodes the value of future earnings. That cost of capital has to start getting repriced as we go forward. And that's what's putting some of this pressure on some of these high growth names in this market right now, is that they were counting on more rate cuts in this period of time. Remember, a year ago, this market was expecting 4, 5, 6 rate cuts, meaning the core rate should now be in the 3 range, 3.5 or something like that. And we're still well above that. And we may not even get below 4 by the end of this year in 2025. So all these earnings estimates in the future have to get repriced around that new high cost of capital for longer.
So the U.S. 10-year bond yielding something like 4.3% right now. If somebody came to you and said, should I put a whole bunch of money into U.S. 10-year bonds right now? My risk tolerance is low. What would you say to them, Brian? I'm sorry, we're a little tight for time.
No, I understand completely. Yeah, I would say that, again, there's some marginal risks in this as well. We've seen the yield down 50 basis points over the last several weeks in the 10-year. So there's actually some variability there, confidence in growth or not. It's still not going to go, I think, much below 4. So your downside risk is probably capped there.
It's great to hear from you, Brian. I really appreciate it.
Thank you.
Brian